The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Andy Duncan, keeping you up to date with expert opinion on precious metals and the markets.
Today we're on a bit of a busman's holiday because it's the 3rd of December and I'm with Alasdair Macleod, who's the head of research for Gold Money and a senior fellow at the Gold Money Foundation. Good afternoon, Alasdair.
Hello, Andy.
You've just written a really interesting report for GATA, the Gold Antitrust Action Committee, and that's about the custody arrangements for GLD and SLV shareholders. And the GLD one in particular is one of the largest private gold holders in the world. Can you tell us about your letter and about your story and your piece on GATA?
Yes, well, it started actually quite some time ago because I was aware of all the rumours about the very poorly drawn up prospectus, the custody agreements, the trustee agreements and all the rest of it, and how American legal minds were really perplexed that here was something which was so full of holes, it wouldn't have passed muster if it was a pure, if you like, American regulated fund or trust or whatever. And this applied to both these particular ETFs. I looked at the prospectuses and I thought, this is actually quite normal for the wording in English law for something which is cross-jurisdictional. But what it does need is it needs to be able to rely on all the parties, you know, the promoter, the trustee, the custodian, the administrator or the manager, as he would be known contractually, actually being properly regulated by a regulator. And that is really the guarantee that you have. Yeah. But of course, this is a different approach, presumably, from the one that the Americans understand. I'm not conversant with American securities law, I would hasten to add. But it seemed to me that this was where the difference was. So really what it hinged on was, what are the custody arrangements and do they conform entirely with the requirements of the FSA as regulator of custodians in the UK? And so it was really on that basis that I wrote to the FSA trying to seek clarification of what the position was. And I sent the letter after I saw Chris Powell, and that was at the GATA London conference. And I think my letter was dated about the 22nd of August, the conference having been earlier in that week. I didn't get a reply for a long time. And this, of course, raises my suspicions that I've inadvertently given them alerted them to a bit of a problem. But they did eventually come back and, quoted the rule in the rule book, which applied in this case. And, it was I was sort of sitting on it. And then eventually I saw that they had changed the prospectus, or rather GLD had changed the prospectus. And what they said in the new clause under risk factors was, effectively, we're not regulated by the FSA, but we basically comply with the good practices of the London bullion market. So that to me was a fundamental change in the security of the assets of the shareholders in GLD and SLV. The fact that it's regulated in a market which is not a regulated market, but is a professional market open to professionals only. They do not have the protection of the SFA. So that to me, I felt was actually quite an important point. And I think, whether it matters or not, I honestly don't know. But it seemed to me that it was sensible that the shareholders in GLD and SLV should be made aware of this fact rather than have it just tucked away in the body of a prospectus with no attention drawn to it, which I think actually is a failing of those two ETFs.
Just to help our listeners who don't fully understand how an ETF works, can you just briefly explain to us what an ETF is, its kind of structure?
Yes. Well, there are different ETF structures, but GLD and SLV were the two first big ETFs, and indeed they are the largest ETFs in these, in gold and silver respectively. ETFs have different structures, but in essence, it is a corporate structure which allows you to have a piece of paper which in theory entitles you to a share of the assets of the ETF. And in this case, the assets of the assets of the ETFs are bullion held by the custodians, who themselves are bullion banks. The way it's set up, as I say, varies from ETF to ETF. What you're buying into is a right to something through a slightly complex corporate structure. And in that sense, it differs completely from, say, someone who deposits their gold or silver with gold money, where it is actually allocated to you. It sits there in a vault which is not owned by a bank, and it's separated out and it's audited quarterly, and we do a financial audit of the metal audit and so on and so forth. So this is an ETF is a very, very different structure. It will have some of the security, perhaps, that you would expect of someone looking after your gold or silver. Of course it will. But the other problem with it is that it is essentially something which is within the banking system. And if you are trying to protect yourself against a systemic failure of the banking system, you have to ask yourself the question, how secure, how separate is my gold or my silver from the bank's assets when the bank falls over? How protected am I by the regulator? And that is why this question was really so important.
And one of the problems with this is that you give money to an ETF seller and they give you a certificate back. They take your money and go and find some gold somewhere and put it into their vault. And that your piece of paper that you're holding as the investor represents apparently that lump of gold in their vault. But this market-making bank could also be a bullion bank and could be selling gold short on the futures market. And so it's both buying gold and holding it in one part of its division, and it's selling gold in another part of its division. And if push comes to shove, there's the potential that they could take the ETF's gold to fulfill their commitments on the other side of their business. Is that the problem?
Fundamentally, you're absolutely right. It is a conflict of interest. It's a fundamental conflict of interest. And the only protection that you really have is proper regulation. The Chinese walls, if I can use a term which seems to have dropped into disuse, the Chinese walls within the bank, where, between its trading operation, its custody operation, its lending operations, where gold may be made available as collateral for something else, hypothecated, rehypothecated, and so on and so forth. I mean, you have got to be absolutely comfortable that the bank does segregate out your property from its own property. And you have to be absolutely comfortable that if circumstances change for that bank, then that is still true. The fundamental reason why it is so important to have this separation is the conflicts of interest within these very, very large banks are extremely important. And, you just need that protection. They are so conflicted, it's not true.
Now, most people buying into an ETF which has a custodian in the UK may have assumed that they had this FSA protection. But the line in your article which really caught my attention was the custody operations of the custodian are not subject to specific governmental regulatory supervision. So now we're on to the good practices of the LBMA. What's wrong with the good practices of the LBMA?
I honestly don't know, because I've never worked in a bullion bank dealing in gold or silver on the London bullion market. I don't know the answer. All I do know is that it is a market which is set up for the participants in it who are all professional bullion banks, large dealers in gold, people who do not need the protection of a proper regulator. So it is that proper protection that is not being offered to the shareholders of SLV and GLD.
So we've moved from this FSA protection then to this thing called NIPS, which is non-investment products. Now that's regulated by the Bank of England. So aren't we still sort of being protected by the Bank of England rather than the FSA?
Well, that's an interesting one, because here again, I would say that the Bank of England could well be conflicted, because there is evidence that particularly the Fed and the Bank of England, possibly, maybe one or two other banks, have been leasing gold, not only their gold, but perhaps gold they've held in sight accounts for other central banks. They've been leasing gold into the market to try and keep the price under what they might deem control. So you do have a conflict here. If things start going horribly wrong, if you like, the top regulator, and the Bank of England aren't really a regulator in the direct sense. What they're doing is they're overseeing a market rather than regulating it. Again, here you will have the Bank of England conflicted in this, and you begin to think, well, hold on, is this safe?
I mean, layer after layer of conflict.
It's layer after layer of conflict and opportunity. Let's put it that way.
Here's the $64 million question then. ETFs are probably okay for people who are trading on a day-to-day basis. Their pieces of paper go up and down along with the price of gold. So you can short them, you can do put and call options on them, and you can play around with them to make money that way. But what you're saying is that for the reason you're holding gold, perhaps, is you're worried about the banking system collapsing. So if you want to buy gold to protect yourself, the last place you want to keep it is inside an ETF inside the banking system.
Exactly. That is entirely my view. ETFs are very, very good vehicles to buy and sell gold if you want to invest. And by definition, investor is someone who buys something with a view to selling it. So, you're not interested as an investor in, the potential for systemic failure. You might have that in the back of your mind, but essentially what you're doing is you are thinking, I want to buy silver today at $33.50, and I look forward to selling it at $40 or $45 on a 6-month time frame. Whatever it is you have in mind, then an ETF is fine on that simplistic level. If, on the other hand, as you rightly say, you are worried about systemic risk and you think, I need to protect myself in the case of systemic risk, I need to protect myself in the case of a currency maybe losing its value, which in these days of QE and all the rest of it, and Europe falling over and Japan beginning to look like that might implode financially, is actually a severe risk, then you are not going to protect yourself by having your money in ETFs, because it's all tied in with the system. You want to escape the system. And so essentially, I think you either have money not in a safe deposit box, because again, that's in a bank, but you can bury it in the garden at home, or you can use someone like gold money, which specifically stores bullion outside the banking system.
Can you just clarify something for me? You just mentioned the Bank of England and other banks leasing out Austrian and German government gold and so on. Do the ETF market makers lease some of that gold and put that inside the ETF as encumbered gold? So if there is a systemic collapse, the Bank of England will claim that gold inside the bullion bank's ETF. Is that possible?
That's a very good question. I personally think not, but all I can do is express an opinion on this because I don't really know the answer to this. To my knowledge, it hasn't really been tested. The point about gold is it's fungible. So it's rather like saying, I've got a £10 note in my pocket. I give it to you. I don't expect necessarily that £10, that particular note back. I expect another £10 or 2 fivers or whatever. So its fungibility basically means that it works on a basis where it is exchangeable, completely exchangeable. But having said that, we've got this odd thing that each bar is separately identified and can be identified. Now, I don't know what the terms of leasing agreement between, say, the Bank of England and a bullion bank is, whether they turn around and say, we actually want these specific bars back. I suspect not. But in any event, what happens with a leasing agreement, or what's happened in the past, is that the bullion is leased off the central bank. The bullion is then sold into the market. The cash in the old carry trade back in the 80s and 90s was then invested in government securities, short-term bills maybe, if it's a 6-month lease. So, you're paying something like 0.5 or 0.6% for your gold, and you're picking up, in those days, in the sort of 80s and 90s, you were picking up, say, 7-8% or something on a 6-month bill. I mean, it's wonderful. And of course, the central bank loved it because it helped fund the government deficit of the day. And, lovely. But once the bullion has been sold into the market, how do you get it back? And in those days, when the price of bullion was low, this bullion basically disappeared and went into melt for jewelry and things like that. And quite a lot of it, we don't know how much because that's the nature of the beast, disappeared off into Asia, and particularly in those days, India. And in those days, it was probably smuggled. Also the Middle East, Turkey, places like that. So when it comes to getting the gold back, it's just not there. It's gone. and so we have a problem. Houston, we have a problem.
I always have this image in the next James Bond film of him looking for a gold vault outside Abu Dhabi and not being able to find it because it's buried so far in the desert. And one of my favourite James Bond films, Goldfinger, Ulrich Goldfinger is able to identify a gold bar from its stamped-on badge within half a second of James Bond presenting it to him on a golf green. Now, in your article, you say that full independent audits of ETFs are what is required to give confidence back to the marketplace. Do you think these full independent audits are likely?
Well, GLD and SLV do a metal audit. I think I'm right in saying that it's once a year, but don't hold me to that. What they don't seem to do is to connect the metal audit with a financial audit. The financial auditors, it seems to me, and I must admit it is a little time since I looked at this because I've just been concentrating on the custody aspect of it. But the financial audit basically looked at the GLDs and SLVs books and signed them off. But you need to tie the two together. And I'm not sure that that has been properly done. But it just seems to me that there is so much confusion over this. There is so much confusion in the market as to whether GLD's gold and SLV's silver has been used for other purposes. There is the possibility, which was suggested by Andrew Maguire, that the custodian has been lending gold or silver, as the case may be, to the banks who are authorized to deal with these ETFs, if you like, directly, and thereby turn what is an allocated account into an unallocated account. Now, I don't know if this is possible. I couldn't work out in that particular case how the book entries would occur. I couldn't get my mind around it. But I don't think that's the point. I think the point is that there has been so much confusion over this. I think it is something that does need to be cleared. And I think it would be good for the health of the market, apart from anything else, to have these issues properly dealt with.
Now, I'm going to let you push our own book at Gold Money and ask you this question. Do you think until these audits are done that people should just stay away from these ETFs?
It's not for me to say, really. I note, for example, that people like George Soros will quite happily buy GLD. He's been recently in the market, so I'm told, buying GLD, which is fine. I think it's something that you have to make up your own mind on, because there is so much confusion over the whole issue. Go and look at the documentation, work it out, think, well, am I happy with this or am I not? And I think above all, think what you're trying to do by investing in gold. Are you actually trying to protect yourself against systemic failure? Or are you in there for a fast buck? And if you're in there for a fast buck, it probably doesn't matter that much. Depending how fast your buck is, of course.
2 days, 3 weeks, 10 months, exactly. 5 years.
2 years, maybe you might have a problem, yeah.
Now, we've spoken mostly about GLD, and your article speaks mostly about GLD. SLV haven't changed their prospectus, but are you just as concerned with SLV as you are with GLD?
Well, I missed the change in SLV. No, sorry, I missed that clause in SLV, which is slightly different wording, but that was always in their prospectus. So we had this situation where GLD was saying one thing and SLV was saying another. And SLV, as far as the prospectus is concerned, obviously always believed it was regulated or conformed to the good practices of the LBMA and was not required to conform with the custody rules of the FSA. So in that sense, they were slightly different. And I think what's happened is that GLD has come into line with SLV, but by coming into line with SLV, they have taken the line of leased regulation rather than regulatory security, if I can invent a phrase.
Now, you mentioned earlier that lots of this gold is moving to India and places as jewellery and various other kind of collectibles and fabricated gold parts. Can you just tell us how you think gold is flowing around the world at the moment? It seems to be going from west to east. Does this seem the case to you?
Yes, very much so. And I think there's one very, very important reason for this, and that is that in Asia, gold and silver are regarded as money. They know from experience that it is a better savings medium than the paper monies offered by their own governments. I wrote an article about this from the point of view of an Indian who got married, let us say, in 1964, 1965. His dowry, the dowry that his wife would have got, which is sort of gold jewelry, bangles and things like that, fabricated would be the cost of the equivalent of about 200 rupees an ounce, probably slightly less. Now, over the years, our married couple would have had a family. I mean, let's assume that he's a sort of lower middle class type of guy who probably has a stall or two in the bazaar, or even a little shop or something like that. Typical Indian sort of family, as it were, the backbone of India type. And over the years, when he was particularly fortunate, he might have put a bit more of his savings into gold. When children were born, he would have given them some gold or put some gold aside for them. And over the years, he will have run his equivalent of our pension fund entirely in gold. And the wisdom of this becomes apparent when you look at the price of gold in rupees today. From 1965, we've gone from under 200 an ounce, and today it's about 95,000 rupees an ounce. So you can see how it really is the most secure, successful pension fund that 1.2 billion people in the subcontinent could possibly imagine. And then think of another thing. If are sort of newly retired, a couple decide that they get the travel bug and they want to go somewhere else in Asia, they will find, I think, that their rupees are refused everywhere, but they will be able to buy things with gold. So for them, and for the whole of the Asian continent, gold is money, and that is the key to it. Now, we have forgotten this in the West, and we've forgotten it partly because our central banks have persuaded us that this is no longer money.
That we can trust them to print paper.
Whatever the story, exactly. But they have actually invested a lot in trying to disabuse us of the idea that gold and silver are money. So we are very much out of the habit. But the fact of the matter is that paper money only has value when you use it in the jurisdiction for which it was produced, like our Indian guy. I mean, he will take rupees in his stall all day long, but he will convert what he doesn't then spend on into savings in the form of gold. Driven by that psyche, you can see that there is a constant demand for gold, and the success of the Asian economies in the last 10 years has accelerated that demand hugely. Now, James Turk did a very interesting analysis where he reckoned that the outstanding stock of gold at the end of 2011 was about 155,000 tons. And of that, the question then arises, how much of it is in the West and how much of it is in the East? And it feels to me, and if we include Turkey, who, according to the World Gold Council, got something like 5,000 tons, if we include Asia Minor, the Middle East, and also, if you like, east of the Urals, China and Japan, I think you're probably looking at well over 2/3 of the world's gold has gone into those hands. And importantly, if, as we suspect, the Western central banks have been selling into the market one way or the other over the years, the bulk of their stock, then we actually have very little left over here. So what you have seen, in effect, through the suppression of gold prices by the Western central banks, is a huge, great wealth shift from West to East. Now, that might not matter if paper currencies never collapse. But with what's going on in terms of systemic risk and all the rest of it, which I was referring to earlier, if paper currencies do collapse, then suddenly this does become very, very important. And I think people haven't woken up to this, to the fact that gold is now predominantly in the East, not in the West anymore, and how important that is.
Well, if we could learn from the Chinese as well, because they've had many paper money collapses and they've learnt those lessons. And even the Roman Empire collapsed partially because the Romans spent a lot of gold on buying silks from the Far East and various other perfumes and exotic spices and so on to create the same kind of conditions in Rome that we may be near to now. Now, speaking of China, they're encouraging their citizens to buy gold and save in gold, and it's very easy to go and buy gold at your local Chinese bank in China. Do you see that there's a possibility that if there is a systemic banking collapse, that the Chinese will arise like the phoenix from the flames to create a golden renminbi?
Quite how they will rise up like a phoenix from the ashes of a general paper money collapse, I don't know. But I think in general, there has definitely been the policy of encouraging people to put their savings into gold to a degree. And that is very important because there is no doubt in my mind that the Western paper currencies are not only intrinsically valueless, but that valuelessness will be realized sooner or later. Now, under those circumstances, I think China has in effect protected herself to a substantial degree from that collapse by ensuring that gold and silver is well distributed amongst her citizens. And it's very, very interesting because you would think that for a government and central bank which is keen to build its own gold and silver reserves, or particularly gold reserves, that they would not tolerate their own citizens being in the market, buying gold against them. But that is not the case. They have allowed and progressively encouraged people to buy gold over the last 6 to 8 years, 8 years, I think. And that rather suggests to me that the Chinese government, if not the central bank, actually has a lot more gold than we really do think. I think it's quite possible they've got more gold than America has, than the US Treasury. Now, if that is the case, that does begin to make sense, that they feel that they would benefit in relative terms from a collapse of Western economies. And I think that's actually what it's all about.
So a golden renminbi could be a possibility.
Well, I don't know what happens with the renminbi, but, that is a paper currency. There is no convertibility of. And I suspect that in a very, very general sense, they will try and ensure that the renminbi doesn't collapse along with the dollar and maybe the yen. But how it is going to pan out in the future, I really don't know. And I think there is another aspect, and that is around Asia, the cross-border trade settlements, they want to get away from the dollar. And the gold actually becomes a very, very sensible way of getting away from the dollar. Because not many listeners will realize this, but every transaction that happens in Asia in dollars is reflected in a bank account back in New York. And that, I think, it gets up the noses of the powers that be in places like China.
Well, in China, they're possibly consuming all of their own gold production and storing it in vaults in China. And they're possibly also as well taking out a lot of the central bank leased gold from the West. Now, what do you think of the problem of central banks in Europe and the West moving gold around between each other and leasing out each other's gold?
Well, inevitably, it's rather like a game of musical chairs. At some stage, the music stops and then you all sort of run around trying to find a chair. Now, so far, Germany has lost out in this game. It seems that they don't know how much gold they've got. They don't know where it is. They know what their books say, but it hasn't been audited for an awful long time. And they've been caught with even the government auditor turning around and saying, well, we really do think you should audit your gold held at the Fed and held in the Bank of England. Austria was interesting because all their gold, they say, was held at the Bank of England, and they very proudly announced that they'd earned $300 million in leasing fees, which basically means that the gold has probably gone into the market and isn't there anymore. So they're reading the Bank of England for it. Now, I've got lots of friends in Austria, and I think it's a lovely place and all the rest of it. But looking at it from a British perspective, I see the Bank of England having a sight account, perhaps, with the Central Bank of Austria, and not having the gold to back that sight account. So we have a problem. This probably started really with Venezuela, with Chavez moving his gold out. And of course, we've had the same problem with Mexico. So we'll find, and also I think the most recent one was the Netherlands. Suddenly, there are lots and lots of journalists beginning to dig around and say, where is our gold? Does it exist? Why have you got it in a foreign bank? And this, I think, is a story which over 2013 is going to be a very, very interesting one to watch. I would follow that very closely because that could have a major impact on the price of gold.
Do you think Britain could lose all of its gold if the Bank of England has to make good on its obligations and, say, give British gold to Austria to make up the difference?
I wouldn't rule it out. But, you've got a problem, really, because the Central Bank of Austria, in that case, has to, they can't really turn around and say, we don't trust the Bank of England. And equally, the Bank of England is going to say, well, you've got to trust us that we've got some gold for you. Or that we can deliver on the promise. So we've got this sort of rather ridiculous problem, which I think the senior central bankers would just hope went away. But I have no doubt in my mind that it is the inevitable consequence of the US government trying, after the Nixon shock, to disassociate gold from all monetary affairs, all dollar monetary affairs completely. And they've done this by, first of all, they had a period of sales through the bull market in the late 1970s, none of which suppressed or kept the price of gold back. In fact, if anything, it stimulated demand. And then you've had this leasing where it's just sort of gradually gone out from the market, never to return. So we have a systemic shortage, and that is a real problem, and that is now coming to light as various central banks are being caught in the glare of publicity, trying to defend where their gold is, how much there is there, do they know what, have they audited it, and what evidence have they got to back up whatever they say. So I think it's a big, big story for 2013, I really do.
Yeah, they're like a lot of rabbits terrified and a lot of very bright headlights.
Absolutely, yes.
Now, it's been fascinating talking to you today, interviewing a fellow Gold Money podcast interviewer, but we better do a proper job. So as well as being head of research for Gold Money, you also run your own website. Can you tell us about that?
Well, I started with financeandeconomics.org, and the reason I started doing it was that there were so many things that I felt were not being properly explained. And the best way for me to examine this and come up with a proper explanation was to write it and send that round to friends of mine who would then turn around and say, Macleod, you're talking rubbish, or how very interesting or whatever. And so that's how it started. The discipline of being read by, people people that I've known in the city who are experts of one sort or another, who understand the financial system, who understand things like systemic risk. That I thought was a very, very good discipline for me. And it really sort of rather went from there. And eventually I was invited to write for Gold Money. And my basic belief is that we should promote sound money, and gold and silver are very much in line with sound money because they are sound money. It's as simple as that. It is they are the money of society's choice, not government's choice, and government is not society. So really the objectives of the Gold Money Foundation and Gold Money itself are entirely in accordance with how I see things should develop for our own security, if you like, financial and otherwise. So I've been very happy writing for Gold Money and look forward to continue to do so.
And you write some great articles, especially on your own website as well as Gold Money. Gold is power, gold is money, gold is liberty. Thank you very much for your time today, Alasdair Macleod.
Thank you very much, Andy.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.